It took the 4:30am starts, a run, ice bath agony, clear mind clarity, projections that added up, then didn't, the deal on the table, news of regulation changes, the deal slipping away. Urgent school pickup, urgent new projections, the forecast turning, a rival bid landing, a near-perfect pitch. The waiting, the legal papers arriving, and a signed deal for this corporate leader to finally relax. It's not for everyone. The Australian Financial Review, the daily habit of successful people.
The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, it's my Chanticleer colleague. He's got a full tank of very pricey petrol and he's ready to go. It's Anthony Macdonald. How are you, Anthony?
Just glad I got the full tank, James.
Fantastic. This week we look at how the Iran oil shock will actually hit the economy. We examine the RBA's big call on interest rates and reveal why the generation scrambling as mortgage costs rise isn't necessarily the one you think. But Anthony, let's start with the big corporate news of the week. The big Australian has a big new boss. Brandon Craig is the CEO of BHP, taking over from Mike Henry, who had a very successful 6 years in the job. But Anthony, Brandon Craig has a lower public profile than my auntie's cat. So I've got two questions. First, is he cut out for the job? And second, what is the deal with all these CEO changeovers we're having at the minute?
I've got to admit, James, and I feel bad about this, I can't say I've met Brandon, and I've never heard too much said about him. Same as your auntie's cat. He was an absolute bolter in this process. You know, BHP's head of the Americas, South African born and bred, now an Aussie, working abroad for the big Australian. When you step back and think about how BHP's changed its story and is reshaping its portfolio towards copper and South American copper in particular, you know, to round out the Australian iron ore business, the appointment makes perfect sense. I'm just not sure why we didn't all see it coming. I mean, you met him the other day. What's Brandon Craig like?
He's a bit of a miner from central casting, as a lot of these BHP types are. Nothing wrong with that. His resume is fantastic. As you said, perfect for where BHP is. You know, he's like a bridge, I reckon. He's a bridge from iron ore to copper. He's a bridge from the old Billiton that BHP famously merged with in around the turn of the century and the new BHP. He's a bridge between, you know, the existing business and these growth projects. He's worked on several of those and getting them to fruition. The bit I sort of liked about him was right at the end of the chat we had, and when he said, "I'm really competitive." That's not something that people admit to that much anymore, but I quite like that. It's going very well at the moment. It would sort of be easy to come in and say, you know, I'm just going to keep steering things along. But he was like, I'm competitive, I'm ambitious, I want this place to go even harder. That's something that BHP investors should like. He's not going to go crazy on some big deal. In fact, he repeated the sort of company line that any deal would have to really be something out of the box for BHP to pursue it. Anthony, just to get back to this idea of CEO changeovers, on the very same morning that BHP's new CEO, Woodside Energy, our big oil and gas player, also announced a new CEO. We've seen new CEOs at CSL, Lendlease, ASX. What is with this? Is this a big changing of the guard?
Sure is, James. I mean, Brandon the Bridge Craig is going to have plenty of company in the CEO school this year. There's lots of change in the CEO suite. More than 20% of the top 200 companies have a new CEO, according to JP Morgan's Jason Steed, who's their head of research. I mean, that's more than normal. It means there's twice as many new CEOs here in Australia as there are in the US among big companies. And he says, and I agree with him, that it's indicative of a strategic reset going through corporate Australia. Yeah, it's it's the end of the pandemic era, well into the AI capital discipline era, and it's a tough time to be taking the keys at an Australian company. Like, yeah, sure, they're paid really well. The average CEO, I think, is paid 55 times the average Australian, so they get paid well. But if you think about what they're staring into, the domestic economy, it's capped out at about 2% growth. You know, it's pretty consolidated, our industries. M&A is on the nose with investors. So, yet growth is absolutely required in listed markets. So where do you find growth?
Yeah.
And then if you step back, you've also got this geopolitical instability, the rates uncertainty, Trump carrying on like a wild card, China growth plateauing, some supply chain fracturing. There's a lot going on, and
Yes.
all of these CEO changes happen for their own reason. BHP, the time for a new choir master. Send the current guy, Mike Henry, who you're very glowing about, out on top. Use that solid platform as a chance to launch the new era. Woodside was the other big one this week. Like you said, Liz Westcott, the interim CEO, she got the nod for the permanent position, replacing Meg O'Neill, who was pinched by British major BP. So good on Meg. So they're all happening for their own reason, but a lot of them are happening at the same time. And I do think it signals a new era for Australian business.
Yeah, I just wonder, I'm with you though, I wonder what that era looks like. It's a strategic reset, but I'm not sure we've really got a good sense of what the strategies are. Because you're right, it's hard to pull off M&A. Most of the markets are mature. This is not a time when the geopolitical backdrop is really conducive to taking big bets or taking big risks. So it's going to be interesting to see what this new guard does. Is it sort of more of the same? Is it minor tweaks? Does one of them break out eventually and do something really, really different? It's going to be really fascinating to watch, I guess.
Now, James, our week opened with the fantastic banking summit. Shout out to the AFR's banking guru, James Ayres, a very good friend of the Chanticleer podcast and a loyal listener, for a terrific event. There was lots of talk about AI and Iran, as you'd expect, but we also learned that banks are minting it right now, with loan growth from the housing market and the business market absolutely flying. But James, there's some interesting stuff going on behind the scenes, and you've spotted something intriguing in the mortgage market.
Yeah, I got some data from Equifax, which is a big credit bureau, just on where the inquiries about mortgage refinancing are coming from. Now, you'd expect rate rises, that's going to hurt younger Australians who are struggling to get into the market. But what this data shows is they're actually holding up pretty well. Probably due to a combination of bit of Bank of Mum and Dad, bit of the government's first home deposit scheme, which has really helped activity in the last little while. The segment of the population where mortgage refinancing inquiries are running hot, and talking about 12% growth in February alone, it's the over 55s. So we always think that boomer generation's the one that's doing really well. They are scrambling to sort of sort their finances out too. I think it points to two things, Anthony. One is that cost of living pressures are across the board starting to really bite. We already had one increase in official interest rates in February. That's starting to come through, or at least starting to transmit into the way people think about their mortgage and can they get a better deal should they shop around. The other thing it says to me is that people are holding mortgages later in life. It used to be you wanted to sort of be done and dusted with your mortgage around that 55-year-old age group, if you could. But the increase in the cost of housing, maybe a bit of pressure to be the bank of mum and dad for your kids, that means that people are holding their mortgages later in life. So I just found that really interesting. We always think that changes in conditions in the housing market hit the young hardest, and they do hit the young, but it's also at the other end, the sort of other end of the spectrum, a group in a different stage of life, they're also feeling the pinch a bit too. But what the banking summit showed us, Anthony, credit growth is just red hot right across the economy, isn't it?
Yeah, the bankers are having a good time at the moment, James. And I think Angus Sullivan, who heads up CBA's retail bank, he said, yeah, sure, competition's hot, but it has been hotter.
Yeah.
Returns are a little bit better than they were a couple of years ago, but they're still nothing like they were 10 years ago, 15 years ago. And that's because of the regulatory change that's happened. APRA's really cracked down on them, needs them to hold more capital against loans. So I thought the big news out of the summit, and the most interesting thing was that the sort of APRA winding back some of the capital requirements on the banks for the first time in more than 10 years, supposedly going to make it a bit easier for them to lend to infrastructure and business. They won't have to hold so much capital against those loans, which encourages them to lend more. The banks will like that. That was just sort of like an interesting pivot, I think, from APRA. At a time when we've heard for years now the banks complaining that they can't do a lot of the business they used to. It's just not profitable for them, which has sent a bunch of loans out into that private credit sphere that we talk about a lot, particularly around the property sort of development side. maybe this shows a little bit that the regulator wants to see the banks doing more. And maybe they like all these loans inside the banks more than they do elsewhere in the system.
You're right. The direction of travel looked pretty positive for productivity and business growth. So let's hope that comes through, because I think the banks do want to lean into a more productive and bigger Australia.
Okay, James, let's move to our first topic. And once again, we just have to look at Iran. The war is now approaching its 4th week, and the reality of the massive energy shock is here. Prime Minister Anthony Albanese has set up a fuels task force as supply worries skyrocket, and there's been reports of hoarding and prices of oil and oil-related products just keep pushing higher. James, can you start by giving us the latest on what's actually happening in the Middle East?
Well, I think the big news to focus on this week is the tit-for-tat bombing of actual oil infrastructure.
Yeah.
Don't worry too much about the markets for a minute. They'll do what they're going to do. But what we've seen here is Israeli forces bombed Iran's big oil field at a place called South Pars, and Iran immediately retaliated by bombing a complex in Qatar called Ras Laffan. Now, Ras Laffan is probably the most important LNG producing gas field and facility in the world. Produces about 20% of the world's LNG.
Wow.
And it gets exported to everywhere. They've got very long-term contracts with the likes of Italy, Belgium, Korea, China. Now, what that says is the LNG is going to Asia and Europe. So this is crucial. There was a great quote in the FT from an oil expert who said, this is the sort of Armageddon scenario that we didn't want to see in the war, where not just the Strait of Hormuz is closed and tankers can't get through, but now the actual production infrastructure is being hit in a way that means that even if the war stopped tomorrow, the flow of oil and gas won't be immediate. Now, the Qatari authorities are talking that it might take 3 to 5 years to get this Ras Laffan facility completely back up and running. So what that says to me is you can get caught up in what's Donald Trump saying, what's Scott Bessent saying, what are the Iranians saying, what are the Israelis doing. Look at the infrastructure. This disruption is not going to be done in a couple of weeks. It's not going to be done in a couple of months. We could be having this energy shock spill into the second half of this year quite easily. And if we see more of this infrastructure targeted, which is completely possible, that could extend the sort of aftershocks of this war. Now, for all that, there are some signs that maybe the exit ramps are being found. Trump's declared victory about 22 times and seems to be saying every second day that this war is going to be over any tick of the clock. There's some cracks in the Iranian resolve as well, that there were reports that the Iranians are thinking about some sort of toll system where people could basically pay the Iranians to get ships through the Strait of Hormuz.
Wow.
So what that says to me is they might be looking for an off-ramp too. So that's good news. The funniest thing, though, I think we've heard this week, Anthony, after bombing the crap out of Iran for 4 weeks, the US are now talking about lifting sanctions on Iranian oil so oil can flow around the world more easily. So there's lots, you go on social media, there's a million strategists talking about, Trump's playing 5D chess with this war and he knows exactly what he's doing. I think the simplest explanation's often the right one. The Americans look like they're absolutely scrambling to try and put this genie back in the bottle. And, the idea that the outcome of the Iran war would be to lift sanctions on Iranian oil is just remarkable. But Anthony, I went to an event this week with a few ASX directors, and the sense that this is really serious and a very large shock, even in Australia, it came through throughout the conversation. It was almost all these directors wanted to talk about. Can you give us a bit of a sense how this energy shock is actually playing through the Australian economy? Because I think it can all seem like a bit of a theory, but we're starting to see some of the cracks here appear.
Yeah, you're right, James. I mean, the directors are worried, aren't they? The CEOs, the CFOs, the management teams, They haven't seen this before. Like even in the COVID pandemic, GFC, for those that were around nearly 20 years ago, they didn't have to worry about shoring up these supply chains like they do now. And rising oil prices touches heaps of sectors, really, across the economy. I mean, the most obvious are the transport companies. Aviation's the big one. Burn heaps of jet fuel. Spoke to an analyst this week who reckons Qantas has gone from making $7 million a day to losing $3 million a day at the moment, right? $10 million turnaround, right? So it's raising prices, but it basically can't raise them fast enough to keep up with its fuel costs because, it's forward sold a bunch of tickets. It can't go and reprice those. They're done. Interestingly, Cam Wallace, who runs Qantas' international arm, he came out on Friday morning and said Qantas is going to start reviewing its prices on these international fares fortnightly, right? So much more frequently than they do otherwise, just to try and keep up with the oil prices. So I hope you've got your tickets booked already for any upcoming holidays, James, because the prices are only going one way.
I do. I'm just fretting. Is there going to be enough fuel to actually get the plane off the ground?
Yeah, I mean, and the other thing Qantas does is it hedges against the oil price, but not against the spread that it needs to for the avgas price, right?
Yes.
And the latter's absolutely ballooned. So the oil price is up, but the avgas is through the roof. So it's getting pinched on that side, and it's not just Qantas, it's airlines globally. The other place to look for who's getting squeezed, anything that's a big user of diesel or fuel. So the miners are an obvious one. So Brandon the Bridge Craig's BHP, guess how much diesel it uses a year?
Tell me.
1.85 billion litres.
Oof.
Right. Mate,
Yikes.
diesel's up near $3 a litre in Sydney. I don't know how BHP pays for it or where they're buying it from, but the price has escalated. I mean, Fortescue's about half that, 900 million litres or so. That's 2.5 million litres a day, right, to shift its iron ore around the Pilbara. Mate, Twiggy can't lay those 3,600 solar panels a day fast enough.
No.
At the moment.
Indeed.
James, and just think about anything else with trucks, utes, big fleets. I was speaking to one of those companies this week, James, not a miner, industrial company, said they buy a lot of their diesel and other oil-based products on a 1-month forward basis.
Yep.
So they haven't actually been pinched on the prices yet. But come the contract resets on April 1, everything's going through the roof.
Yeah.
And then a little bit further afield, fertilizer, chemicals, a lot of the raw material inputs, limestone, sulfur, ammonia. Middle East is a big player in all this, Middle East oil, and the ship's not getting through the strait. It's hard to get out. Fertilizer, think about that. Fertilizer prices double. What's that mean for the cost of food?
Yeah, totally.
This is an essential ingredient needed by farmers to grow the stuff that we're eating every day. It's quite prevalent and quite widespread, James.
And Anthony, it's not just prices. I spoke to a manufacturer this week. They're in packaging, right? Mm-hmm. Yes, okay, prices are going up. That's obvious. But it's not just prices. It's actually being able to get this stuff at all. There just aren't the stores of resin or diesel or whatever it is. Those barrels of stuff are starting to run out. The inventories are starting to be exhausted. So it doesn't matter where the price goes. If you can't actually get the stuff, that's where the trouble hits. That's the danger here, isn't it?
Absolutely, James.
And Anthony, those are the first order effects, but then you start thinking through the second order effects, right? There's lots of industries that might not be hit directly by oil prices, but they would be if consumers start to struggle, for example.
Yeah, they would. So even if you're in a sector that's not directly impacted, like those I just mentioned, you're probably using products that come from those industries, aren't you? A lot of the raw materials, manufacturing there. What's going to happen to those prices? Your cost of goods sold go up. So you've got to either increase your own prices to maintain gross profit margins or take the hit. So the big second order impact, though, James, like you just said, it's on the economy.
Yeah.
Right. And the economy feels these oil shocks immensely. Right, so there's been 5 big oil shocks since the 1970s that pushed Brent crude to more than 50% above its underlying price. Okay. Right, the most recent was Russia and Ukraine.
Yep.
There's been 4 others, all about the Middle East. In 4 of those, 4 of the 5 led to the onset of a recession globally. In all 5 of them, inflation went through the roof, both headline inflation and the trimmed mean or core inflation that central banks look at. Yep. It's like nothing drives up inflation across the economy like oil prices. So if prices are going up, inflation's going up, what do central banks do? They raise interest rates to slow the price increases. You can end up smashing the economy and jobs. So that's what we're dealing with, James. The price of oil, it's not quite in that oil shock territory. Not quite. But it's close to it.
And certainly the prices of, as you said, the prices of jet fuel and fuel for ships and fertilizer costs and resin, that's all starting to get into shock territory, isn't it?
Absolutely, James. And that's the risk. So just the spillover effect into the broader economy. Now, James, I wanted to bring in a question we got through the widget you'll find on Chanticleer articles at afr.com, which is from Nicole in Western Australia. And I'm going to ask you this one. Nicole says, if Trump seeks to limit exports of energy from the USA and requires this energy be used as a way of servicing domestic demand and keeping the price of petrol at an artificially lower price, that would force up prices in Australia, correct? If Trump did this, what other ramifications could there be?
This is a great question, Nicole, because it hit the markets on Thursday night, this rumour that the US could restrict exports of its oil and gas. At the moment, what we're seeing is a lot of Asian refineries who don't usually buy from American sources are going to the American market and buying oil and gas from there because America's a big producer through its fracking sector. That is one of the market's fears, that America, for either political reasons or economic reasons, will say, right, that's it. No more exports. We're keeping it all for ourselves. It would definitely push up the prices for the entire world, including Australia, Nicole. And I think if Trump did this, what ramifications would there be? Well, it would be a further disintegration in that sort of global order that we've been talking so much about over the last couple of years. You know, it would be a real every country for themselves moment. You know, it'd have huge ramifications, not just for this war, but for what happens after. Can you trust your allies to help you out when you're in a pinch? Obviously, Trump keeps talking a lot about that at the moment. The US government came out on Thursday night and said there are no plans for export controls. We're going to do the right thing by everyone. Relax. But in the back of everyone's minds, I think, Anthony, they'll be thinking, yeah, that's the case now. What about if this thing was going for 3 more months, 6 more months, 9 more months? What if it was still going next year? Would eventually export controls have to be put in place? I think that's the danger, isn't it?
Scary thought, James. I mean, like energy markets with oil at the heart of it and now gas sort of coming in behind it. I mean, they are like the true global market.
Yeah.
You know, like this really is one of the marketplaces where we're all relying on each other, where the movement of these things isn't normally restricted, and we're relying on products from the other side of the world every day, you know, not just for the oil and gas themselves, but then all the byproducts from that. So any breakdown in that, I mean, that could take trade tensions to a whole new level, you know, like nothing we've seen.
Yeah, forget Liberation Day. That'd be something else. Okay, Anthony, it's not just investors and politicians thinking about this. Central banks around the world have had to deal with this oil shock too. So let's have a look at how the RBA tackled this topic on Tuesday. So, Anthony, the RBA did as expected and raised rates by 0.25% to 4.1% on Tuesday. It was the second consecutive hike, and there's a clear possibility that there's more to come. Was this the right call by Michelle Bullock and the RBA board?
James, if decisions can be made by the head or the heart, I think this is the decision made by the head. You know, It's the call that's backed up by the data.
Yep.
You know, inflation was running at 3.8% in the December quarter. The most recently quarterly data. The trim mean was 3.3%, both well above 2.5% target, both accelerating. Since then, we had the monthly data, slightly less reliable, but it showed headline inflation was still at that same level, elevated. The trim mean inflation was slightly up. So the trajectory on the trim mean is still going in the wrong direction.
Yeah.
Employment, the other side of the mandate, was 4.1% when the Reserve Bank's Monetary Policy Board met. I mean, it's now at 4.3% post-meeting. We got some updated data on Wednesday.
Yeah.
But at 4.3%, the jobs market's still tight.
Yeah.
Employment actually grew 49,000 jobs in February, 2.5 times market expectations. The unemployment rate went up because the participation rate, which measures the people out there willing and able and looking to work, went up to near record levels. So basically, the jobs market's still tight. James, the decision, like I said, that's backed up by the data. I mean, since that meeting, I've heard almost one-way traffic, from CEOs and chairs, business people complaining about it.
Yeah.
I think they're more inclined to make decisions with their heart on this one. They say the RBA should have waited. There's so much uncertainty about Iran and the oil shock, the timing, how long this is going to go for, the extent of it, that there'd be no harm in waiting 6 weeks until the next meeting to tap the brakes again when households have probably only just noticed that first cut and it's not really in the economy yet. And surely, James, that feeling is what underscored the 5-4 split at the Reserve Bank about this decision. I mean, you can imagine the debate, act now or wait and see.
Yeah.
And unfortunately, it's probably not the way the boards and business see it, but I think Michelle Bullock's telling us The wait and see is also a very active decision in this environment.
It's a risk.
Where inflation's already hot. Yeah, the jobs market's already tight. This is not a CapEx decision that a company makes where you can delay it a month or two and see what happens to funding costs in the meantime or whatever. This is one that will have real knock-on consequences. And remember, Bullock's probably only there because inflation ran away from the last governor, Philip Lowe, which triggered the whole Reserve Bank review and Monetary Policy Board being created, the press conferences and all that stuff. It was interesting though, James, we had a bunch of major central banks meet this week, the Federal Reserve in the US, the European Central Bank, the Bank of England, the Bank of Japan, etc. They're all on hold. Let's stay on Michelle Bullock for a second. Last week, we had a great question on the podcast about whether rate rises were the best response to an energy shock. I don't know if Michelle Bullock listens to the podcast or not. But
Surely.
Yeah. Let's just assume she does. She obviously heard the question and she gave a much better explanation than we did during her press conference on Tuesday. I reckon it's worth a listen.
We have tried, I think, very hard to explain why it is that we only have one instrument, and that is the interest rate. And the interest rate works through a few channels, and I'll try to set them out in simple terms. The first is obviously what we call the cash flow channel. So that is those people that have mortgages pay more on interest, and that means that they have less spare money. So that's the cash flow channel. There's two other channels. There's one which is basically if you put interest rates up, people are encouraged to save more and spend less now. So that puts a bit of downward pressure on demand. And the third and quite important channel is the exchange rate. And as the exchange rate rises, it puts downward pressure on inflation. It makes imports cheaper. People tend to buy imported goods rather than domestic. And so it puts less pressure on the domestic side of things. So that's how I try to explain to people how the interest rate works its way through. Now, having said that, I understand that for people with mortgages, all they see is the cash flow, and it's tough. But, as I've said, if we don't do what we think we need to do to bring inflation down, ultimately the outcome is worse for people. And people haven't seen high inflation up until 22 or so. People hadn't seen high inflation in decades. And that gave people a taste of what, if you let inflation get a roll on, how hard it will be continually for people. So it is hard. I understand that, but it is the only instrument we have, and it is important that we get inflation down.
I heard this and I thought, gee, she said it a lot better than we did. But it really comes back to the psychology around inflation for me. What Michelle Bullock's really worried about is that if you look at the data, it says that inflation got outside the RBA's target band, which is 2 to 3% inflation. It got outside the target band in late 2020 as we had that sort of pandemic shock. Mm-hmm. Now, even on the RBA's forecasts before the war in Iran, it wasn't going to get back to the band, the target band, until the middle of 2027. That's 7 years with inflation outside the target band. Now, who knows what this Iran shock's going to do? Is it going to push out inflation? Are we not going to get into the target band until 2028, 2029? I don't know. Is there a chance that we could be 10 years outside the target band? I reckon there might be. The prediction is that inflation's going to 5% in the next, little while as this energy shock hits. So what Michelle Bullock is trying to stop, what she must prevent, is this idea that you just come to expect inflation will be higher for longer, higher forever. She has to try and get that out of the system, and that's really what she's saying there. If we don't fix this now, it is going to be so painful to try and fix it. It could take us years and years and years. Look, it already has taken them years, and they still haven't successfully got it out of the system. I think she's got the messaging right. It's still a contentious decision. Anthony, you mentioned before that I think 4 of the last 5 oil shocks have ended up in recession. And that's interesting because Bullock was asked several times on Tuesday whether the economy actually needs a recession to get inflation under control. Now, none of us like the R word, but are we going to be hearing more of it?
Yeah, it's not something we've had to think too much about in Australia in my or your working lifetime, is it, James? The big old recession. There's only been one since I got my first proper job in COVID, which was caused by the massive government-mandated lockdowns and the closure of international borders, fought with huge stimulus, the economy reopening, and it was a bit self-inflicted, but sort of all wrapped up in what was going on globally. We got out of it. Previous one before that, 29 years earlier, the recession we had to have in the 1990s. I mean, we've been so blessed here in Australia, thanks to China's demand for what we're selling, particularly iron ore and coal. Also, we're blessed by our relative wealth and jobs growth, which has kept house prices strong and banks' balance sheets strong. Immigration, the economy's kept growing. But yes, it came up again this week, and it's always noticeable, isn't it? Like the ears just prick up when the RBA governor just says the word. Bullock said we don't want to see a recession if we can avoid it. And Ed Boyd from Sky News, son of the longest-serving rooster and former host of this podcast, Tony Boyd, jumped on it straight away. And he said, hang on, you just mentioned the word recession. If the war in Iran continues indefinitely and the Strait of Hormuz is closed, how concerned is the RBA about looming recession risk? And, it's a great question. We're talking about the exact same thing now. And, Michelle Bullock said sort of like, hang on, young fella, just go back a year. We had the tariffs, and what we were all saying about the tariffs at the time that we were looking at a recession, look what happened. That's all blown over. The world economy's in quite a decent place heading to this war. So thinking about recessions and looking at the crystal ball, it's always part of it, but that doesn't mean they actually happen. But sure enough, the recession genie's out of the bottle. Michelle Bullock got a couple more questions about it. Would you be willing to put Australia into a recession if you had to?
It's logical, isn't it? I mean, we have to have a slowdown. That's what interest rates hikes are designed to do. We have to have a slowdown. Does that slowdown become a downturn? Probably has to get inflation sustainably back below 3%. Does a downturn become a recession? It's quite possible, isn't it? I mean, it's not illogical.
And it's not the RBA's goal either, but Michelle Bullock, I think she's always going to stand there and say, if we have to do it, we'll do it.
But it's not our preference.
Yeah, but it's all about those, like you said, it's all about those inflation expectations, which you can kind of understand it because the inflation number itself, the Reserve Bank struggles to control. Like it copped flack for years and years and years about inflation being below the target. Yes. And then you said, what is it, 7 years almost, inflation above target. So the number itself is hard to really land in the target, so it targets inflation expectations, which makes sense. But James, if you step back and think about what happened this week, so the RBA's hiked rates, they've done it twice in 2 months now. There's a lot going on in the background. Is there any chance they're making a big mistake here? Like, could they make a difficult situation worse with this rate hike?
Well, possibly. Tim Toohey, who's the head of macro and strategy at Yarra Capital Management down in Melbourne, long-time economist, he suggested, think of yourself as an alien that comes down from the far-off reaches of the galaxy and you're presented with this hypothetical. The economy is being whacked by an oil shock that is unprecedented in the description of basically every expert in energy in the world. The economy is about to be whacked by the biggest technological shock that we've seen in, at least 20 years with the AI revolution. There's this persistent private credit strain problem that just won't go away and continues to sort of infect parts of the US financial sector at least. And if you had those three potential shocks or real shocks, do you think the RBA would be raising rates or cutting rates? And when you think about it like that, you sort of go, that's a really good question. You would probably expect the RBA to be cutting. I mean, certainly in COVID, when we had the previous big shock, the RBA cut rates rapidly. The government chucked extraordinary amounts of money at the economy through fiscal stimulus. But this is a different ballgame. Should it be? Not sure. If this situation in Iran really does blow up into a full-blown energy shock, I'm talking the supermarket shelves are difficult to keep full. We're rationing petrol. We're working from home to save energy. We're driving every second day of the week. I'm taking this to the extreme here. If it does turn into one of those full-blown shocks, do you reckon the RBA will be hiking rates still? I'm not sure. Bullock had to do what she did this week, and the RBA board had to do what they did this week. But I think this is a pretty dynamic situation, and I think it's always good to sort of look at the other case. What do you reckon, Anthony? Is Tim off the planet on this one, or?
I'm still thinking about that alien that came to Earth to talk about the economic settings. To be honest, James, of all the things the alien's going to think when it gets to Earth, I mean, I'd recommend the alien try jumping in the ocean, maybe tasting a few of our summer fruits, maybe some watermelon, mango, etc. But it's good to know that some aliens out there are interested in such hardcore things like economic policy.
Aliens are big on inflation.
But yeah, I think Tim's point, absolutely. If you put it all together and see the direction, the long-term direction we're likely heading in, there's so many different variables, so many different outcomes, and we are heading potentially into tough times with this oil shock. But to Michelle Bullock's point that she made in the press conference, like think back to the tariffs and Liberation Day and what we were all saying back then too, and look what happened. So, everything takes time to play out. But fortunately or unfortunately for the RBA, their decisions have to be made on board meeting day. And like I said, at the moment, they're all active decisions. Sitting and doing nothing is an active decision when inflation's at 3.8%.
All right, Anthony, well said. Let's come back after the break. There's another key bit of data for the RBA that's coming out next week. We'll have a look at that. Back in a second.
It takes a certain type of person to succeed, the type that puts in the work when no one's watching, that knows staying informed isn't optional. It's their edge. It's not for everyone. The Australian Financial Review, the daily habit of successful people.
Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Anthony, I think this might almost be the last earnings result of earnings season. Comes to us on Tuesday from Myer. Tough time to be a retailer, isn't it?
Sure is, James. We've heard a lot about discerning shoppers and now people are only buying things on special. I mean, you spoke to Premier Investments, Solomon Lew, Friday morning, right? What did he say about the retail environment?
Well, he's worried.
Is he?
What he doesn't like is the convergence of inflation and the signs that there are a few job cuts out there in the corporate sector. That's what he doesn't like. Very sanguine about the Iran hit, though. Said he hadn't really seen it in sales. Only in the last few days has he seen a bit of an uptick in domestic freight costs. He did make a really good point. The Australian dollar has risen quite sharply over the last 6 to 8 weeks, and that will offset some of the higher costs from freight. So, little bit of hope, I guess, there, but yeah, it's not an easy time to be a retailer. Sol Lew's been doing this for 63 years. He's been around the block a few times, but his view is that there are some retailers out there doing it pretty tough. Anthony, I mentioned the RBA's got some important data next week. The monthly inflation gauge for February comes out on Wednesday. Economists are expecting 3.8% year-on-year growth and 3.4% for the trimmed mean, which takes out energy and food, those volatile things. The RBA is a little bit skeptical about this monthly inflation data because it's new and it's still jumping around a bit. But everything we get on inflation is going to be really important at the moment, isn't it?
It is. But unfortunately, the decision's been made for now, James. So no matter what that number is, we're going to be paying 25 basis points more on our mortgages.
We're in this weird thing, Anthony, because, it used to be we had the RBA meeting every month. But now we're on this 6-week rotation. We don't get another meeting until May. It's quite a long time to wait, isn't it?
It is, and it feels especially long because of how we're glued to our screens every morning to see what happened in Iran and the US overnight.
Yeah, great point. On Thursday, there's a big super and investor conference in Melbourne put together by the Victorian Government and a few of the super funds down here. It's called the Asia Pacific Financial and Innovation Symposium, which is a very grand name for a day in which basically, rich American dudes come down to Australia and say to super funds, will you please give me some more money? Now, that's interesting enough in itself, but this year, holy heck, Anthony, could the timing be any better? We've got people from BlackRock, from Apollo Global Management, from Blue Owl, which is the sort of become the poster child for private credit paying right around the world. We've got Shamara Wickramanayake from Macquarie and Robin Cooder from AirTrunk, and even our old mate Mike Dorrell, the chairman and CEO of Stonepeak. Now, Anthony, Robin and Mike and Shamara will be talking all about AI. And I know you appeared on the Fin podcast this week talking about another AI upstart, Firmus. But this symposium is going to be pretty interesting, isn't it, to hear how these big dogs from the US sort of explain all this mess in private credit world.
Lots going on at the moment. So much for them to talk about, James. The three big rolling risks in market: Iran and oil, AI, private credit. I mean, these people are all right in the thick of it. Tell me, are you going to this symposium?
I am going to be there. Absolutely. Yep. Going to be good fun. These guys usually have a pretty sort of similar message that private capital is great, particularly if you've got a long investment horizon like super funds do. But I think this year they've got a lot of explaining to do, and it's going to be interesting to see how the messages change. All right, Anthony, we love questions here at the Chanticleer podcast. We had one earlier from Nicole, but we've got another from Jamie in Western Australia. If you've got a question you want to send in, you can email us at chanticleer@afr.com. We've got the link in the show notes. You can also send us a question in audio form. Just record a voice memo on your phone and include your name and where you're from and email it to us. Or you can do as Jamie did and write in via the widget, which is on all of the Chanticleer articles at afr.com. And we'll ask our producer Mandy to do the honours with Jamie's question.
Hi Chooks, a millennial here, so I understand my view might be biased, but I had a question about the possible CGT changes being discussed. I completely agree with decreasing tax on work and increasing tax on assets, and agree that CGT should be reduced. However, explain to me how grandfathering it in is not just the older wealthy generation pulling up the ladder behind them. It's yet another policy decision to make the younger generation pay while the older generation profits.
Very interesting take there, Jamie. Anthony, I'd be of the view that some change on CGT discounts is better than none. The grandfathering makes it politically palatable. Is this just the pragmatic result rather than the perfect result?
Jamie. The starry-eyed idealism and the dewy-eyed wonder, positivity of youth. Yeah, Jamie's right. You're right, James, in what you just said as well. If you're going to do it properly, radical change, redistribute the wealth intergenerationally today, you'd do the whole thing.
Yeah.
Politically, though, so hard. You know, governments always have one eye on the next election, on the polling. There's a whole grey army out there very worried about what they've got, what they've always worked towards, how they've invested under a system, 50% capital gains tax discount that's been there since September 1999. So if you don't grandfather this and if you change the rules on them, yeah, very painful. And I'm not sure the government is up for that fight.
Yeah.
Let's be honest. We don't see Anthony Albanese on the front page every day prosecuting this one.
No.
It feels like it's a priority, but it's not a burning priority of the government. I mean, they haven't set up their whole government platform on this, on redistributing the wealth. So it's going to be done, if it's done at all, with this grandfathering, which means it takes quite a while to wash through. But I think we need to also recognise, James, that changing the capital gains tax discount, making it smaller so people have to pay more capital gains tax,
Yep.
that will change investor behaviour.
Totally.
I mean, I think that's a fair assumption. We do need rental property. I mean, that's partly why this came in. The problem is it was also implemented alongside pre-existing negative gearing, which means property owners could all of a sudden get tax deduction on rental losses and pay a lot less tax on the gains when they sold the property.
Yep.
So that's obviously how you create an asset class, Jamie. And so we've created an asset class out of the same market people are probably trying to buy a house in, Jamie, or at least how I would view it, you know, like it's housing, not an investment. So, I mean, the cat's so far out of the bag on that. We need these investors in the market, particularly at the lower end of the market. You can't afford to scare them all off. You know, the government doesn't want to crash the housing market, but they've got an eye on the politics of it all. So I think that's why we're landing where we are.
I take a little bit of heart, Anthony, from the fact that if we talked about changes to the CGT discount, I don't know, 12 or 18 months ago, it would have been a political firestorm. Now, all of a sudden, I think over that period, it's become accepted that we need to do something. There's going to be changes in the federal budget. I'm taking that as a little bit of progress, I reckon. You got to take the wins where you get them. And as you say, it will make a difference to investors. Jamie's right. Maybe grandfathering it doesn't get the full effect, but let's celebrate a win because tax reform is so hard. But at least it looks like we're going to get something this time around. All right, Anthony, another massive week. I fear we're going to be in the trenches again next week, looking for the off-ramp, seeing if Donald Trump and the Iranians can pull back from the brink and make this inflation problem less worse. So looking forward to bringing our listeners all the latest developments next week.
Sure will, James. I'll speak to you next week.
If you like the podcast, send it to a friend as it helps others find us. And don't forget to follow wherever you get your podcasts so you'll never miss an episode. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people. Chanticleer was hosted by me, James Thomson and Anthony Macdonald, and was produced by Mandy Coolin. Our theme is by Alex Gow. Head of Audio is Alex Gow, and Head of Premium Content is Fiona Buffini.
The Australian Financial Review.
It takes a certain type of person to succeed, the type that puts in the work when no one's watching, that knows staying informed isn't optional. It's their edge. It's not for everyone. The Australian Financial Review, the daily habit of successful people.